Okay, just to let you know a little bit about ETFs, index funds, and mutual funds. Same, but different, let's call it. Mutual funds is when somebody manages your money in a fund. It could be a bunch of stocks. Let's say John, Jack, and Jilly wanted to invest in IT companies. One of them goes to Google, one goes to Facebook, one of them goes to Microsoft. And let's say one of those companies lost a lot of money. They'll individually, that person who invested in that one company will lose a bit of money. However, let's say they piled their money together and gave it to someone who knew a little bit more about the stock market. And he created what's called a mutual fund. And he did an IT mutual fund. Now the money would be kind of managed with someone researching it. However, there is fees with this. And a lot of these fees, usually called MERs or management expense ratio, are in the fine print. You don't necessarily see them taken off on your statements, but they are. So mutual funds could be costly because when your mutual funds go down, you're still paying that fee and you don't always see it. At the same time, not everybody knows how to invest in the stock market. They don't know how to look at stocks and see what's going to be good and bad. So they'll trust a financial advisor with this. Now, keep in mind, there was some statistic I heard, and I'll put it in the notes there if the statistic's wrong. There was one statistic I heard, something about only 15% of financial advisors would beat the stock market 2 years in a row. You'll always hear about this guy who predicted the '08 crash, or Michael Burry, or someone who predicted something to go up. They only need to be right once for that, but they could be wrong 10, 20 times. And that's a lot what happens with mutual funds. So sometimes when the stock market's down, you're losing even more money due to these fees. Now, index funds are a little different, and we'll talk about index funds and ETFs kind of similarly. Basically, these match the market. There's minuscule fees, and in the United States, the fees are even lower. In Canada, they're quite low, Europe a little more. Vanguard is a great one for these ETFs, and we'll get into in later videos how to invest in these ETFs that run along at the stock market. This is how I teach you to do the road to financial independence, usually investing in the whole stock market. So an ETF would be very similar to the mutual fund in the sense that it compiles a lot of stocks together. However, it runs along with the market. I guess it's computerized. And it's never going to beat the market, but it's not going to go below the market. It's just matches the market, if that makes sense. Now, you could invest in ETFs that, let's say, follow the whole United States market. So let's say the S&P 500, which is the top 500 companies in the States. Now, the beauty of this is that you own a single little bit of every company in the United States. And as J.L. Collins said, I always love this quote, that everyone from the CEO to the factory floor is working for you because you're getting a little slice of this. That's one of my favorite quotes. So let me tell you about this little story. Some woman was cooking like the Christmas ham, right? And before she puts it in the oven, she always cut off the ends. And someone said, "Why do you cut off the ends of it?" And she goes, "Oh, I don't know. My mother always did it." So she goes to her mother and I said, "Oh, why did you always cut off the ends of the ham?" And the mother goes, "Oh, well, your grandmother always used to do it." So she goes to the grandmother and asked, "Why did you always cut off the ends of the ham?" And the grandmother goes, "Well, the tray wasn't big enough for it to fit in when I was cooking back in the day." So sometimes we have these things that we do just because of our relatives and parents did them, but you don't actually need to do them. Now, mutual funds, a lot of people, especially in Canada, will always invest in mutual funds because their parents saw it as secure. But the way index funds, ETFs, and digital investing has changed, ETFs can be a lot better these days. Now, keep in mind, I'm not a financial advisor. I'm just telling you what I do. So you don't have to take my advice. Just hear me out on what I do. I think I have to say that for legal reasons or something. So keep in mind, just because your parents told you to do it, do your own research. Don't, and obviously, just because I say that's what I do, don't necessarily do that either. Do your own research. So I'm hoping that makes it a little clearer the difference between ETF, mutual fund, and index funds. Index funds are kind of like ETFs, but I think there's usually a minimum charge or a minimum investment amount. Whereas ETFs, you can buy as low as a few dollars. And for me, it's easy to buy online. You can buy index funds in all sorts of things. You can buy them in environmentally friendly companies, in IT companies, in oil companies, in the whole stock market, emerging funds, Europe, Asia, Far East. You can buy it in real estate. Like one example was a real estate investment trust, which was run along at over 6% per year, I think. And the beauty of that is a lot of people who go into real estate investing, like a good ROI or return on interest is 6%. But to do that, you need to manage the house, you need to manage the items in the house, maintenance, etc. Whereas you having a real estate investment trust, easy. You're getting pretty much the same profits without having to fix the house. Someone's managing it for you.